Right. So that was the first part. Then we move on to the second part of our discussions. And we will be done in a few minutes. Right. So if you have any questions, then we're going to attend to any questions you might be having. Right now, let's focus on the equities and liabilities. So you will remember what equity is made up of. We said it's ordinary share capital, preference shares, retained earnings, and so forth. And then your liabilities could be current or non-current. Your non-current liabilities are those that are due for settlement in more than 1 year, right? While current liabilities are due for payment within 1 year from the date of financial reporting date. Remember, when you do your financial statements, it's for the year ended 31 December or the year ended 31 March. So from that date, if something is due for payment after more than 1 year, then it's a non-current liability. And if something is due within 12 months from the reporting date, then it's a current liability. So these are examples of your current liabilities, right? You have your accounts payable, or these are also your creditors, the people that you owe, or trade payables. Then we have notes payable. That is to say, we borrowed for a short time and we have to pay back. Right? Then tax payable, that we have to pay SARS. Then wages and salaries payable. That is to say, we haven't paid people their wages and salaries, and we need to pay quickly. Then your non-current liabilities include your long-term loans, your bonds, and your mortgage, where you can take a loan against a building for like 20, 30 years. Right, now, here is a question from the previous assessment. So in the past year, a firm received cash from clients amounting to 10,500. That is the cash received. Then the firm paid creditors and employees an amount of 3,700. So cash paid to employees and creditors is 3,700. Then the interest paid amounted to 1,500. Then interest paid is 1,500. Remember, this cash received is an inflow. Then the payments are outflows. So they are reducing our bank account balance. So that's why we put them in brackets to say these are negative cash flows. Right? Then they didn't pay any dividends, because if they had paid dividends, we would also subtract those dividends here. But we'll focus on the dividends that were actually paid. But sometimes companies can declare dividends but not actually pay immediately. They can declare dividends, for example, this is August, so they can declare dividends in August and pay in January, right? So we're interested in the dividends paid, not declared, right? And then they paid tax of 700 rand, right? So what that means is the cash flow from operations, in other words, the net is not just the cash flow, but the net cash flow. That's what they're referring to. Is going to be what we received minus all those things that we paid for. These are going to be cash flow generated from operations, right? Which is 4,600. So this is part of your cash flow statement, right? But you just need to know this portion only. How do you determine cash generated from operations using this this format here, where you get the cash received from customers, and then after that we have to deal with the payments that have been made. So what were we left with? What was left remaining in the entity, right? Right, you need to know this. This is very important. So please make sure that you understand this. Right. Then we have the basic accounting equation, and I said here you need to revisit this for a reminder. You need not do everything, But you need to remember that our assets are going to be equal to equity plus liabilities. So here is one of the questions that was examined based on that. You are given total liabilities 600, owner's equity 150. Then the company's total assets is. So we are given equity. We are also given the liabilities. So the equity is 150, the liabilities is 600. But we know that our assets is going to be equal to equity plus liabilities. So we can determine now our assets being 750. So this is also very important, very simple, very important. Make sure that you make sure on that. Right now, let's talk of the income statement. Right. So the income statement, like I said to you, it measures profitability. Right. So it's going to show you things like your gross profit, your profit before tax, right, and the profit for the year. So in finance, we normally say earnings before interest and taxes, EBIT or EBIT, and then the net profit, which is your profit for the year. So these are the things that you will see in your statement of comprehensive income. And it is also known as a statement of financial performance, not position. All right, so just make sure you read carefully, because they can play around with some words, and they can include some words which could appear correct, but then they're definitely not correct. Right. So this is an example. Right, and this is also very important. Right, we are given that a firm expects sales of 1 million, so the sales is going to be 1 million. Then they have opening inventory of 400,000. So we have to say less opening inventory of 400,000. Remember, opening inventory is an expense. So if I've explained these things to you, that opening inventory is an expense. Then closing inventory is income. So it's not going to be subtracted, it's going to be added. So the closing inventory here is a plus. Then purchases, we are told that the purchases are expected to amount to 35% of sales. So our purchases will be 35% of that is 350. That's also an expense. So our gross profit is going to be equal to 750, right? Then our operating expenses is 600. So we say gross profit minus expenses. We are left with earnings before interest and tax of 150. So this question here just required you to know how do you the format of the income statement. So then you give your cost of sales there. Right. Remember that your cost of sales is opening inventory plus purchases minus closing inventory. So that's why here we said opening inventory plus purchases minus closing inventory. Then you're gonna get your gross profit here. Then you add your other income. It's gonna be added. Then you add your other expenses. It's gonna be added here. Deduct rather. Then we have your earnings before interest and taxes. So this is the format. Then assuming that it's going to be a profit, not a loss. Then we have finance costs or interest expenses. It's gonna be here, right? Then we have profit before tax. Then we have taxation that has to be paid to the government. Then we have net profit or profit for the year. So in this particular question, we were provided with the sales. We could calculate the cost of sales. We get gross profit, then other expenses. They wanted this portion here, right? So you should be able to make sure that you can do these things and do them well. Moving on, then this is the information that we are provided. It's for Famous Foods. Now we have sales of 450, then earnings after interest, or this is earnings before tax, or profit before tax is 150. Then taxation is going to be 32%, obviously, of the profit before tax. Then a preference dividends, then preference shares issued, then ordinary shares issued. Then the question wants us to calculate the earnings after tax. So only gonna take the earnings after interest, then we remove the taxation based on that. So this earnings after interest is also the profit before tax. If you come here, it's in the layout that we gave here. We have earnings before interest, then we have the interest, then a profit before interest, or profit before tax, or earnings after interest. After we have deducted interest, then we have earnings after deducting interest, which is profit before tax, or earnings before tax. Remember, this is earnings before interest and taxes. Then we remove the interest, we're left with earnings before taxes only. Right, so here, if we already have the earnings before tax as 150, then the rate of tax being 32%, then we're gonna have the tax to be paid as 32% of that. Then the earnings after tax, or the profit for the year, is 102,000. Then they says calculate the earnings per share of Famous Foods. Now the earnings per share refers to the earnings available to share or ordinary shareholders. So in this case, as you can see, we have ordinary shares, we have preference shares. So before we give ordinary shareholders their share, we have to give the preference shares first. Preference means they are given preference before ordinary shareholders. That's why they are called preference shares. So what it means is, whenever we have some money, we have to pay the preference shares first before we pay the ordinary shares. So that's where the preference comes from. They are shares, but these ones are ordinary. These ones have a preference. So now from the profit that we made, which is 102,000, we first of all have to pay the preference dividends, these ones, which is 50,000. Because before we pay any ordinary shareholders, these guys have a preference, receive a preference. So we have 102 left after we pay tax. Now we have to pay these shareholders because they have a preference over ordinary shareholders. We pay them 50,000. Now we don't pay them the number of shares. We pay them the preference dividends, which is 50,000. Now what is left now is what is the earnings available to be given to shareholders is 52,000. So that 52,000 has to be shared among 10,000 shares that were issued. Right. So each share is gonna get 5 Rand 20. Right. So that's the earnings per share. Right. These are extremely important things. They are easy, but you need to make sure that you're comfortable with that so that you can be a happy student. Right. Now they will say calculate the net profit margin. Margin, if they say margin, it means over sales. Sales or revenue is going to be the denominator. So we are going to say net profit over sales. Right. Whenever they say margin, if it is gross profit margin, it means it's gross profit over sales. If they tell you tax margin, then it's tax over sales. If they say whatever margin, it's that thing over the sales. In this case, they want us to determine the net profit margin. So we need the net profit. And remember, the net profit we already calculated is as here. Our earnings after tax, that's the net profit. So it's going to have the net profit here over the sales, right? So we're going to have 102,000, which is the net profit, which is the earnings after tax, then over the sales. And if you multiply by the 100, we get 22.67%. Right, guys, so that was the discussion that I wanted us to have. We can't finish everything in one day. So what I'm going to do is that I've done a recording of this and I'm going to share with you. Then there is another portion that I haven't covered. Then I'm going to cover it another time. Then I'll also share the recording in our Telegram group. And then we will also cover the time value of money. But the time value of money and other revision questions will only be covered in class for the students who have enrolled for our tutorials, right? But if you are okay without tutorials, then it's fine. Whenever we host a free session like this, you can be there, join in, benefit yourself. But if you think you need like assistance to make sure you're actually going to pass the module, then you can inquire about tutorials. It's an option, right? So some of these are going to be strictly for the students in class, but some discussions are going to be for everyone, like this one. Right, so if you'd like to access more resources, here is, you can just WhatsApp this number. If you haven't joined our Telegram group already, then you will be given information as to how to join the group. Then you will join that group. Right, thank you very much. We have come to the end of the discussion. Hope that it has helped you a lot.